Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor. In today's video we're talking about mortgages and how to get a mortgage, what they are and why I believe they're essential if you're looking to invest in property. So if you like this sort of video, give it a big like, it does help me out with the algorithm, and if you haven't already subscribed, consider subscribing, because until we get to 10,000 subscribers and we're growing fast, you can book a free one-to-one call with me. Just click the link in the description. Let's get into it. I don't like long intros. Let's find out a bit about mortgages. So the first thing is to understand what a mortgage is. All it is a loan that's secured against a property. Now there are several types of mortgages. You'll hear the terms thrown around: variable rate, fixed rate. Those are the two main types. Now, a variable rate or a tracker mortgage, that tracks the Bank of England rate. And both types of mortgage have their place. And I'll explain a little bit about why I think both of them have advantages and disadvantages. So with a fixed rate, they typically come 2 or 5 years is what people tend to fix at. And after that period, you go on to the standard variable rate, which will be much, much higher, sometimes as much as 5% above base rate. So a much bigger jump. And at that point, most people would go out and get a new fixed rate product. Now, a variable rate mortgage simply tracks the rate of the bank. So what it could be is you could have a lifetime tracker, which for the lifetime of the mortgage, maybe 30 years, if the Bank of England put the rate up, you might have 2% above Bank of England rate. So if the Bank of England's 1, you're paying 3. If the Bank of England's 5, you're paying 7. Now the good thing about that is you get the market interest rate. With fixed rate, although you have the certainty in the short term, you have to keep fixing every so often. Now, every time you deleverage risk, you pay for someone else to take on that risk. So the way that I look at it is, unless I'm looking to remortgage, I want to have a variable rate for a long period of time. If I'm looking to refinance and get money out of a mortgage, then I want to do a fixed rate mortgage. So let's say, for example, I buy a property tomorrow, I secure a discount on that property, it's worth 100, I pay 90. I'm assuming capital appreciation over the next 2 years will take it up to somewhere 110, 115. And at that point, I want to refinance the money back out. Well, a fixed rate makes perfect sense. I refinance in 2 years at 115,000, I pull out about £20,000, I've got most of my deposit back in that instance, and that property is now in perpetuity making an infinite return on investment. Now let's say I've done that and I don't have any appetite to refinance it further, and maybe I'm in later stages of life, and maybe I'm in my 50s, 60s, 70s, and I don't really want to be messing around with it. Well, a 30-year variable tracker would be perfect, because over the next 30 years, you're going to get the market return. You're not going to pay any brokerage fees. You're not going to pay any remortgage fees, no valuation fees. You're just going to, as the Bank of England puts up mortgage rates, your mortgage rate will go up. As Bank of England puts down mortgage rates, your bank mortgage rate will go down. You're just going to get market returns over that period. So I guess for me, when I look at this, I like to think of it as, if I have a reason to refinance, i.e. I want to pull money out of properties, and certainly during the beginning stages of my property investing career, I wanted to refinance properties regularly as I added value, then I want a shorter fixed term mortgage. If I want to wait for a significant period of time to pass until I'm going to refinance that property, then I might look at something like a lifetime tracker or a 5-year fixed, or maybe even a 10-year fixed in some extreme circumstances. Anybody who fixed their mortgage rates for 10 years back in 2019 probably did themselves a big favour. But we never know what's going to happen with the economy. And this is why I think for the long term, it can be quite dangerous getting into fixed term products. You don't know whether the rates are going to go up and down. You're fixing at a higher rate so somebody else can buy that risk off you. And in my opinion, I'm better off assuming that risk, taking it over the long term, assuming that my level of leverage will mean that other people will get pain before I do, and that things will have to happen, rents would have to rise or interest rates would have to fall before I got hurt. And that tends to be the way that modern economies run. There's always going to be some casualties, but as long as you're not doing anything too risky, it's not going to be you. So that's the way I look at it. So those are two fixed products: fixed rate and variable rate. Fixed rate, I think, great, especially if you've got a time frame for when you're looking to refinance money out, or variable rate, lifetime trackers, all that sort of good stuff, if you're just looking to cash flow it in perpetuity. Now, what do you need to get a mortgage? Now, generally speaking, most mortgages require you to be 21. A lot of them for buy-to-let mortgages require you to be 25. Not all of them. And the more risky you are as a buyer or as a landlord, the higher percentage you're going to pay. Now, that's to say, if you're a 25-year-old with no experience being a landlord and you want to buy a buy-to-let property on a HMO mortgage, you may find it nigh impossible. And that's because most lenders require you to be an experienced landlord before you become a HMO landlord. It makes sense, right? We don't teach our toddlers to run before they can walk. We teach them to crawl first, and then we let them walk, and then we let them run. And the banks want the same when it comes to property investors. If you're not experienced in HMOs, there are so many downsides and so many risks that you're going to be assuming. It's a high level of risk for you to take on, and as the bank is financing that risk, they have a vested interest in the outcome. So many HMO products require 3 properties before you're considered to become a HMO landlord. Now, I don't know if there's products out there on the secondary third market where you will be paying for someone to take the risk. I'm sure there is. But the mainstream lenders, I know for a fact, will not touch you. So what else do you need if you want a mortgage? Well, if you're buying it to live in, you have to have a salary. If you're buying it as an investment, you don't. Because what they're going to do instead is look at what the rental return will be. And at the time of doing this video, if you achieve a certain amount of rental return over the required mortgage payment, then they will lend you that value. Now, these rules always change, and that's why I'm not giving any specifics, because who knows when I do this video what the specifics will be and how it will change. But what I will say is that the rationale behind that is you're not paying the mortgage. Whereas if you're a first-time buyer or if you're buying a home to live in, 4.5, 5.5 times your salary, that's the number you're going to be lent. And that's because you're going to be responsible for paying that mortgage. The next thing that affects interest rates is the deposit, so the amount of loan. LTV stands for loan to value. Now, the lower that LTV, i.e. if you put 50% in, you will likely get a lower rate than if you put 25% in. Again, this is risk and return. So the banks require less capital to hold on to if they're going to make you pay for them having more risk. Whereas if you were putting down a lower deposit, they're taking more risk. If the property crashes below that, will you be able to make your payments? If it gets repossessed, will they return their money? So because they're assuming that more risk, you're going to pay more for that. When you're building a property portfolio, in my experience, it's best to leverage up as high as you possibly can because you're on this growth spurt. And as long as you're buying correctly, you can do this with fairly low risk. And a good example would be find a property that's worth 100,000, buy it for 85, you've got 15% market decline already baked in. Even if you're putting a 25% deposit down, you're not over leveraged on the full value. You're only leveraged about 35% of the true value of that property. And you might say to me, why would anyone sell their property for below what it's worth? But I can give you many examples in my time of when I've managed to do this. And the 2 that stick out in my mind, couple moving to Spain, secured their onward purchase, their buyer fell out, they needed someone to buy it within 60 days, I bought it. But I bought it at a discount. I got it for 89, I think it was, and it was on for 115. And frankly, it was on cheap, it was probably worth 120 at the time. Another example, death in the family, they needed to resolve an issue with the property, it was COVID, it was worth about 190,000 done up, it needed some work. This is Mill Road over in Kettering or Wellingborough, I can't remember which, I think it was in Wellingborough. But that one, we bought it for 126, death in the family, needed to secure the money out because they couldn't afford to renovate it, they couldn't afford to keep it, they wanted the capital, bought it quickly on a bridging loan, and again that was worth 190 done up, and it needed about 30k spent on it. So there was about a 35 grand profit in there for me when I did it. So when I refinanced, I got most of my money back out. So those are 2 good examples, death and moving location, but there's also things like divorce that might require a hurried sale. So there's always these opportunities in the market where people need a guaranteed buyer who's not going to back out, although they might shift it a little bit cheaper, they will shift it. And that is where us investors can make some money. Now let's also talk about interest only versus repayment. Now, as an investor, I use interest only mortgage products. Why do I use interest only mortgage products? Well, because it allows me to hold on to the capital. And I always assume that I can make more than the bank is charging me from that capital. So if the interest rate is 5%, I know that the minimum ROI I could get on that extra money I'd pay on the repayment would be 10 to 15%. And if I buy smart, probably more like 20 to 30%. So why would I pay any of that loan off? Now, the second reason I use interest only is because at the end of the day, I'm an investor. I'm not interested in paying that capital down ever. I'm interested in that property that I bought for 100,000 in 15 years being worth 200, and another 15 years being worth 400, and another 15 years being worth 800. So I'm interested in that small loan becoming so insignificant as capital appreciation and inflation take care of the debt. So again, I'm not from the traditional school of thought where you should pay off your mortgage. I'm from the thought of, can I make more money than the interest I'm being charged on that money? And if the answer is yes, I should hold on to my money. And so far, that's allowed me to scale my portfolio. It's also allowed me to weather storms that if I had the capital tied up in those properties, I might not have been able to weather. So for me, interest only works. Repayment, on the other hand, means you are repaying the principal. And generally speaking, buy-to-let investors aren't looking for that. But if you're looking for a home to live in, maybe you want that security of owning it free and clear at any point in time. But I would make one caveat to anybody. You always own the home, you always own all of it. It's just that there's a loan attached to it. It's no different. As long as you keep up your loan payments, you still own all the home. If the home doubles in value, you don't share that profit with the bank. That's all yours, because it's your property. So when people say to me, but I want to own my home, I'm like, but you do. It's just got a mortgage on it. It's just a loan against the home. It's not a big issue. Now I get that some people can't sleep at night in debt. That's for them. But for me, interest only is always the way forward, especially if you're a buy-to-let investor. And the last thing we're going to talk about in this video is buying property without a mortgage. I don't think anybody should ever do that. I think rental yield 6%, property price going up by 3%, combined return 9%. By the time you've calculated properly for voids and maintenance, it's not worth your time. You're better off putting that money in a low-cost index fund, in my opinion. But leveraged up correctly, it's brilliant. Think about buying a property for 200,000, waiting 15 years, it being worth 450,000. Even if you made nothing on the rent the entire time, over that 15 years, with only putting in £50,000, you've made £250,000. There is nowhere where you get that kind of return in any other financial institution. Unless you're looking at things like crypto, which I've been wrong on, I admit, but ultimately it is still a gamble. It still produces nothing, and I will do another video on that. I personally don't think buying property without a mortgage is ever a good idea, but I already know that's a divisive way for me to leave this video. So hopefully you guys will put some comments down below. Agree, disagree, I want to hear from you. I'll reply to every single one of you, and I'll see you on the next video. Like and subscribe as always. See you soon, guys.